Hello, and welcome back to Money Mastermind. Today we are exploring the #1 mistake teenage investors make and how to avoid it for better results. Now, let's get started, but first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now let's get straight into it. Hey, teenage investing is an exciting journey filled with potential for financial growth and independence. However, many young investors often encounter common pitfalls that can hinder their success in the market. In this video, we'll examine one of the most common mistakes made by teen investors and explore how to avoid it for better results. One mistake that many teen investors make is a lack of thorough research and due diligence before making investment decisions. This oversight can have significant consequences, leading to poor investment choices, unnecessary risks, and ultimately subpar returns on investment. By understanding and addressing this critical mistake, you can set yourself on a path towards more informed and successful investing practices. Join us as we uncover the importance of research and due diligence in the world of teenage investing and learn how to navigate the markets with confidence and skill. Investing without a solid understanding of the fundamentals of the companies or assets being invested in can lead to poor decision-making and unnecessary risks. Without proper research, you may be susceptible to following trends, relying on hearsay, or giving in to market hype, all of which can result in poor investment choices. The consequences of this mistake can be expansive. For instance, investing in a company without understanding its business model, financial health, or competitive landscape can expose you to the risk of significant losses if the company underperforms or faces financial difficulties. Similarly, investing in confusing financial products or volatile investments without a thorough understanding of their risks and potential returns can lead to unexpected outcomes and financial setbacks. For instance, if you invest in a trendy but fundamentally unsound company without conducting proper research, you may experience a substantial loss when the company's stock price plummets due to poor financial performance. Conversely, if you take the time to thoroughly research and understand the companies or assets you invest in, you will enjoy more favorable outcomes and greater returns on your investments. By highlighting the consequences of investing without proper research and due diligence, you can recognize the importance of taking a diligent and informed approach to your investment decisions. Through education, research, and careful analysis, you can mitigate risks, identify promising investment opportunities, and improve your chances of achieving long-term financial success in the markets. Research and due diligence are critical components of successful investing, especially if you are just starting your journey in the financial markets. Understanding why research matters can help you make informed decisions, mitigate risks, and identify promising investment opportunities. Conducting thorough research allows you to gain a deeper understanding of the companies or assets you are considering investing in. By analyzing financial statements, you can assess a company's financial health, profitability, and growth prospects. This information provides valuable insights into the company's stability and potential for future success. Also, researching market trends enables you to identify emerging industries or sectors with high growth potential. By staying informed about market dynamics and economic trends, you can position yourself to capitalize on opportunities and avoid investing in industries that may be facing challenges or downturns. Research also plays a crucial role in evaluating the competitive landscape. By understanding a company's competitors and market position, you can assess its competitive advantages and potential risks. This knowledge helps you make more informed decisions about which companies to invest in and how to allocate your investment capital effectively. To conduct thorough research, you can use a variety of tools and strategies. Analyzing financial statements such as income statements, balance sheets, and cash flow statements provides valuable insights into a company's financial performance and stability. Also, staying informed of market news, analyst reports, and industry publications can help you identify market trends and developments. It's important for you to evaluate the management team and corporate practices of the companies you are considering investing in. By assessing the quality of leadership and governance, you gain confidence in the company's ability to execute its business strategy and create long-term value for shareholders. In summary, research and due diligence are critical for successful investing, helping you to make informed decisions, mitigate risks, and identify promising investment opportunities. By following these tips and strategies for conducting thorough research, you increase your chances of achieving your financial goals. Here are some practical tips to help teens avoid this common pitfall. 1. Educate yourself. Invest time in learning about investing principles, financial markets, and economic trends. Resources such as books, online courses, and educational websites can provide valuable insights into the fundamentals of investing. Take advantage of financial literacy programs offered by schools, libraries, or community organizations to deepen your understanding of personal finance and investing. 2. Conduct thorough research. Use reputable sources of information such as financial news websites, regulatory filings, and analyst reports. To conduct thorough research on potential investments, analyze financial statements and performance metrics to assess the financial health and stability of companies or assets you are considering investing in. Stay updated on market news and developments to identify emerging trends and opportunities in the financial markets. 3. Seek guidance. Consider seeking guidance from mentors, such as experienced investors, financial advisors, or professionals in the finance industry. They can provide valuable insights, share their experiences, and offer personalized advice tailored to your investment goals and risk tolerance. Join investment clubs or online communities where you can connect with like-minded individuals, share investment ideas, and learn from others' experiences. 4. Stay disciplined. Develop a disciplined investment approach and stick to your investment strategy, even during periods of market volatility or uncertainty. Avoid making impulsive investment decisions based on emotions or short-term market changes. Instead, focus on your long-term investment goals and stay committed to your financial plan. By following these tips and strategies for avoiding one mistake of investing without thorough research and due diligence, you increase your chances of making informed decisions and achieving long-term financial success in the market. A solid investment strategy is essential for you to achieve your financial goals and navigate the complexities of the financial market. Here are the key components of a solid investment strategy. 1. Goal setting. Begin by setting clear and achievable financial goals, such as saving for college, buying a car, or building a retirement fund. Establishing specific goals provides a roadmap for your investment journey and helps you stay focused on your objectives. 2. Asset allocation. Determine an appropriate asset allocation strategy based on your financial goals, time horizon, and risk tolerance. Asset allocation involves diversifying your investments across different asset classes, such as stocks, bonds, and cash equivalents to reduce overall portfolio risk. Consider allocating a higher percentage of your portfolio to growth-oriented assets, such as stocks, when you have a longer time horizon and can tolerate higher levels of risk. As you approach your financial goals or your risk tolerance changes, adjust your asset allocation accordingly. 3. Risk management. Implement risk management strategies to protect your investments from potential losses. This may include setting stop-loss orders, diversifying across industries and sectors, and regularly reviewing and rebalancing your portfolio to maintain your desired asset allocation. Avoid investing more than you can afford to lose and be mindful of the risks associated with different investment options. Conduct thorough research and due diligence before making investment decisions to minimize the likelihood of unexpected losses. To sum up, the one mistake that many teen investors make is investing without thorough research and due diligence. This oversight can have significant consequences on your investment outcomes and overall financial well-being. By recognizing the importance of research and due diligence, you can avoid common pitfalls and make more informed investment decisions. We encourage you to prioritize education and thorough research in your investment journey for better results. By investing time and effort into learning about investing principles, market dynamics, and financial analysis, you improve your understanding of the markets and your chances of success. Also, seeking guidance from mentors, professionals, and reputable sources can provide valuable insights and support along the way. To further support your investment education, you can explore resources and tools such as books, online courses, and financial advisory services. These resources offer valuable knowledge, practical advice, and personalized guidance to help you navigate the financial markets and achieve your financial goals. By taking a diligent and informed approach to your investment journey, you can mitigate risks, identify opportunities, and build a solid foundation for long-term financial success. Remember, investing is a journey, and by prioritizing education and research, you can maximize your potential and achieve your financial dreams. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.